Hi guys, so welcome back to class number 14 on CMA and FM. So we were discussing for last many classes on the chapter number 1, decision making tools. So now we are going to continue our discussion. In our last class we have covered problems till additional problems till 25. So today we are going to cover from 26 to 28. So guys, we are discussing on this marginal costing chapter, the decision making tools chapter of CMA and FM. So I think in next 4 or 5 classes we can complete the chapter 1. Chapter 1 is voluminous chapter and it has a very good weightage for examination point of view. So I'm choosing most of the problem which is very unique and very similar problems I'm excluding from the discussion and I'm giving for the homework. And if you have any trouble in making your homework, please post a comment. Also friends, please share the videos with your groups. If you have any WhatsApp group with your batchmates, please share the video. It will be helpful at the time of examination. So if this video reaches by this time, many students can start the preparation in the February itself, and by March and April they can go for revision of these videos. And if the videos reach late, the usefulness of the video for the students will be reduced. Okay, because understanding facts requires viewing the video once, solving the problem once. You will get a lot of doubts. You can watch the video once again and then you can correct your mistakes if there is any, and then you can find the solution. And if you come across any doubt, we have the comment section. You can post comment on this video, or you can post your comment on the Telegram group, for which also link I have shared in my video. So we will move to the next problem. So problem number 26. A practicing cost accountant now spends 0.9 rupee per kilometer on taxi fares for his client's work. Okay, so a practicing CMA is going to client's place for maybe doing the cost audit related work. So he is spending 0.9 rupees per kilometer. He is considering other alternatives, the purchase of new small car or an old bigger car. Okay, of course the practicing is also wonderful profession what CMA has. It's a wonderful opportunity. Okay, so if you are a practicing want to become a practicing cost accountant, this may be useful for you. This is a decision making in which he has three options. One is going by taxi to his client place, or buying a new small car, or buying a old bigger car. Okay, so purchase price of the new small car is given 35,000 and old bigger car 20,000. Sale price after 5 years. So after 5 years of depreciation, the selling price what we can get is also given. Repairs and services cost per annum is given. So taxes and insurance per annum is given. Petrol consumption per liter in kilometers. So in 1 liter of petrol, how much kilometer it can go? So they have given little bit confused, but what they have given the unit of measure is kilometer. So it is how much kilometer per liter. So that is also given. 10 kilometers per liter and 7 kilometers per liter, and petrol price per liter. Okay, for per liter petrol price is also given 3.5 and 3.5. This looks very amazing figure. Okay, he estimates that he does 10,000 kilometers annually. So annually he is going to his client's place so many times. So his total kilometers per year is 10,000 kilometers. So he's the active cost accountant, and he maybe goes and audits even the process level, the manufacturing setup, whether the cost accounting is correct, whether physical movement of material in the factory is correct. Maybe he is doing all sorts of audit before signing the cost audit report. So he does maybe a lot of work, so that's why he has a lot of visits with the company. Which of these three alternatives will be cheaper? If his practice expands, okay, many other companies are coming in for his consulting, then he may require to travel 19,000 kilometer per annum. In that case, which is the cheaper option. Now he is traveling 10,000 kilometers per year, and if he grows and more clients come up, his travel may extend to 19,000 kilometer per annum also. In that case, whichever is the cheapest option, we have to see. Will the cost of two cars break even, and why? So break even in the sense, the cost, what to say, the cost will be same for the small car and big car at what kilometer. That is called the break even between the two options. So if you are considering two options and both options will yield the same profit or same cost, okay, and what is the kilometers or what is the sales related to that, and that is called the break even between the two options. Okay, so we don't know what to choose. Okay, something lesser than this, some option will be better. Something more than the break even point, other option will be better. But at the break even point, both option will have the same impact. Okay, so this is what is the question. So now you are a cost accountant, you are traveling 10,000 kilometer per annum, and you have three options to go, either by taxi or going by a new small car or a old bigger car. Okay, so we have to analyze these three. We are going to analyze the full cost of these three. Whichever is better for us, we are going to choose it. Okay, let me I'm just putting a column particulars, and taxi, what is the cost of the taxi, what is the cost of the new small car, and what is the cost of the old big car. So if we take the repair and servicing, it is given for the taxi, we are not going to spend anything for the repairs and service. So for the taxi, it is 0. For repairs and service, new small car, it is given in the question. And also for old bigger car, it is given in the question, 1,000 rupees and 1,200 rupees per annum. That is given in the question. Next, taxes and insurance, yes, that is also given, 1,700 and 700. And for taxi, of course, we are not going to spend this. Maybe the driver or the owner of the car, owner of the taxi will be spending that amount. Next is the petrol consumption, which is the major consumption. Petrol consumption, it is said that for consumption of the petrol, 0.9 kilometer per 0.9 rupees per kilometer is the taxi fare. So 0.9 per kilometer for 10,000 kilometers, 0.9 into 10,000 becomes 9,000 rupees. Next, for if we are owning our new small car, a new small car will go 10 kilometers in 1 liter, 10 kilometers in 1 liter. So for 10,000 kilometers, okay, 1 liter can go for 10 kilometers. So which means 10,000 kilometer, I mean the 10,000 kilometer, you need 1,000 liters of diesel. So I mean the petrol, 1,000 liters of petrol multiplied by 3.5 rupees is 1 liter petrol. So 1,000 into 3.5 will becomes 3,500. Same way, calculate for petrol. You can go 7 kilometers in 1 liter. Okay, 7 kilometers in 1 liter. So do the same math. You will end up, okay, so 10,000 kilometers you have to travel divided by 7, because 7 kilometers you can go in 1 liter. So 10,000 kilometers, how much liter of petrol you need? 10,000 divided by 7 rupees multiplied by 3.5 rupees per liter of petrol. You can find 5,000 rupees as the petrol consumption. So you have found the petrol consumption, repairs and service we have found, taxes and insurance we have found, and petrol consumption also we have found. Now the last thing is depreciation. This is the major point. Many students misses to calculate the depreciation. But it is given in the question why they have given the purchase price of the car and why they have given the sale price after 5 years. This is to calculate the depreciation per year. Okay. For the taxi, we are not the owners of the taxi. So for taxi, depreciation is nil. In our books, depreciation of the taxi is nil. Okay, if we are owning the new small car, okay, of course in our P&L, in we are practicing CMA, we will maintain a P&L ourselves. We have to bring in the depreciation of the car. What is the depreciation? 35,000 rupees is the purchase price, 19,000 rupees is the sale price. So 35,000 minus 19,000 is approximately 16,000 rupees. So 16,000 rupees is a depreciation happened in 5 years. So 16,000 divided by 5 years is going to be the per annum depreciation. So I have brought in the per annum depreciation cost here. Same way, do the math for the old bigger car. 12,000, 20,000 minus 12,000, 8,000 is a depreciation for 5 years. So 8,000 divided by 5 is going to be per year depreciation of 1,600 rupees. Now I am adding all the cost So if you see in the first, if you compare this, the old bigger car will be the best option because the cost of old bigger car is very less. Till now we have seen problems related to products. It will have direct material cost, direct labor cost, variable overheads, fixed overheads, but now it is like a practicing cost accountant. So the cost heads are different: repairs and maintenance cost, tax and insurance cost, petrol consumption cost, depreciation cost. Okay, because these are all related to a movable asset. Car is a movable asset, right? Okay. Now for 10,000 kilometers we worked out this table. This same table can you guys work out for 19,000 kilometers? Yes, I have done the same here. Repairs and maintenance will not go for any change. Taxes and insurance will not go for any. The same car, same per annum will not go for any change. Depreciation also, it is a per year depreciation, will not go for any change. But the petrol consumption only will change, because that 10,000 kilometers the petrol consumption will be to some values, and 19,000 kilometers it will be little higher. So if it is 19,000 kilometers, so 19,000 into 0.9 will be the petrol consumption for the taxi. Is a taxi fare. Next, you are comparing it with a new small car. So 19,000 kilometers divided by 1 liter 10 kilometers. So how much liters? 19,000 divided by 10 liters multiplied by per liter 3.5 rupees. Apply the same formula. You can find the 19,000. You can find the value for old bigger car also. Okay, so you have found the cost of the older bigger car at 19,000 kilometers. You can see whichever is the cheap option, new small car will be the cheaper option. New small car will be the cheaper option. So from this, guys, if you see at 10,000, old bigger car is the cheaper option, and at 19,000 kilometers, new small car is a cheaper option, which means in between these two, 10,000 and 19,000, there is a point at which these both will break even, which means the new small car cost will also be same, old big car cost also will be same. Did you understand the point, students? The main point is, okay, at 10,000 kilometers, the cheaper option was old bigger car. At 19,000 kilometer, the cheaper option was new small car. So between 10,000 kilometer and 19,000 kilometer, there is a kilometer point at which the cost of new small car and old big car will be same, and that is called the break even point between these two. Okay, so it was asked in the question to find the break even point also. Let's find the break even point. So at the break even point, the cost of the new small car and cost of the old big car both will be same. So what will be the cost of the new small car? New small car, 1,000 rupees is the repairs and service, 1,000 plus 1,700 is the tax and insurance. So 1,000 plus 1,700 plus depreciation is 3,200. These three figures will not change with kilometer. So plus 3,200. Okay. Then what is the petrol consumption? X is the distance I have assumed. Distance X divided by 10, because it is given 10 kilometer can be traveled in 1 liter. So X kilometer divided by 10 will be giving you the total liters of petrol required, multiplied by 3.5 will be the total petrol consumption charge. This will be the total expenses for the new small car. Same way for the old bigger car, 1,200 plus 700 plus 1,600 will be the constant side, and petrol consumption will increase. What is that? X is the distance, X divided by 7 liters of petrol multiplied by 3.5 rupee per liter. Okay, so I'm just equating these two equation and solving for X. This shows X is equal to 16,000 kilometers. So at 16,000 kilometers, the cost of the new small car and cost of the old big car both are same. And you can say, you can correlate with my earlier statement, 10,000 kilometers, old big car was cheaper option, and at 19,000 kilometers, new small car was the cheapest option. So between this 10,000 and 19,000, 16,000 is the point in which these both cases or these both methods break even each other. So if you go more than 16,000 kilometers for your practicing purposes, new small car will be the cheaper option. And if you travel below 16,000 kilometer, old bigger car will be the cheaper option. So similar to this we discussed in our earlier class also, class number 13. So this is very similar to that, but it is little different. So I just want to explain you this problem. Let's move to the next problem. There are two plants manufacturing the same products under one corporate management which decides to merge. So there are two factories, okay, and two factories are under the control of different corporate management, and they are going to merge. The two plants are going to merge, two corporates are going to merge. So plant one is operating with 100% capacity. With 100% capacity, 6 crore is the sales, 4.4 crores is the variable cost, 80 lakhs is the fixed cost. For the plant 2, 60% capacity of operation, 2.4 crore is the sales. At 60% capacity utilization, 2.4 crores is the sales, 1.8 crores is the variable cost, and 40 lakhs is the fixed cost. You are required to calculate for the considering the board of directors. So for board of directors decision making, we have to place the summary. What would be the capacity of the merged plant to be operated for the purpose of break even? So we have to find the capacity of the details of the merged plant and what is the break even point of the merged plant also. That's very easy. Plant 1, all the figures are given in 100% capacity, so there is no issue. Here all the figures I am giving in lakhs. So 600 lakhs, 440 lakhs is the variable cost. It is given in the question. 600 minus 440 is 160 is the contribution, minus fixed cost of 80 will give you 80 lakhs as a profit. Plant 2, all the details given here is for 60% capacity utilization. We have already discussed if the for the lesser capacity utilization how to convert the figure into 100%, or how the if for 60% capacity utilization how to convert that into 20% utilization, how to convert the figures into 80% utilization. We saw in last two classes. Please watch the video of class number 12 and class number 13. You can find the capacity utilization related problems. It is very important to know, because what students will do is they will just add the plant 1 and plant 2. Plant 1 is in 100% capacity, plant 2 is in 60% capacity, and when they add, it will not give you the real capacity of the merged entity. So you have to convert the 60% capacity figures of plant 2 into 100% capacity of plant 2. So how to do it? 240 lakhs is the sales of 60% capacity. So 240 lakhs divided by 60% multiplied by 100% is the 100% capacity or sales capacity. Same way apply that for the variable cost. You can find the sales and variable cost. Sales minus variable cost will give you the contribution. Now the main twist is fixed cost will remain the same. Whatever is the capacity utilization, fixed cost will remain the same, because fixed cost is calculated for 100% capacity and that will be constant. Okay, so 40 lakhs will be same as 40 lakhs. So 100 is the contribution minus fixed cost will be the uh, profit. So profit is calculated. Now if you add the plant 100% and plant 200%, now you can find the capacity of the merged plant. Okay, and they have also asked to find the break-even point. It is very easy to find the break-even point. So for finding the break-even point, what is the formula? Fixed cost divided by PV ratio. Fixed cost of the merged entity is 120 lakhs divided by PV ratio. What is the formula to find the PV ratio? PV ratio is contribution divided by sales. So 260 divided by 1000 is the sales. So 260 divided by 1000, or 260 lakhs divided by 1000 lakhs is going to be 26%. So 26% is the PV ratio. So fixed cost is 120. So 120 lakhs divided by 26% PV ratio, you can find the break even point and you can place that for the board of directors decision making. The second question is, what would be the profitability on working at 75% of the merged capacity? Now you have 100% of the merged capacity, just apply 75% on the sales, it becomes 750. 740 into 75%, it becomes 555. So sales minus variable cost will be the contribution. Fixed cost is, again there is a twist. Here you should not apply 75% because fixed cost is constant. So take the same 120 lakhs for the 75% calculation, contribution minus fixed cost will give you the profit. So profit is 75%, 75 lakhs. 75 lakhs is the so we have answered this question. We have placed all the required details for board of director decision making as a cost accountant. So problem number 28, guys, it is very similar to this problem. There is no possibility of any doubt if you have understand the facts. If you have any doubts, please reach me through the Telegram group or the comment section. Okay, also please share the video to your friends as much as possible. So when you share with your friends, their preparation time will start from now itself. If they postpone by to March or April, we don't know what will be the COVID related situation, or what is the other situation related to the market. So it may be difficult for the students, and now itself you can also start answering their doubts by watching this video. So if you start answering doubts of your batchmates, you will get more stronger in your facts will be registered on your mind so strongly, and before the examination you can proceed for revision if you teach to your batchmates. So guys, all the very best. Meet you in the next video. Thank you.